Wedgemount Resources is an innovative oil and gas developer and producer in the Permian Basin, West Central Texas. CEO Mark Vanry is here to tell us how he's growing the company, both through acquisition and organically. I'm Martin Gago with Market Radius Research. It's Wednesday, October the 9th. Please remember, this is not a recommendation or investment advice. We're here to learn about the company. Mark, good to see you again. You just completed a big acquisition of assets, immediately expanding your production and footprint. Please tell us about Wedgemont and how this acquisition impacts the growth plans.
Oh, thanks for having me on, Martin. It's good to speak again and go through what we've been up to over the last little bit. Just to give a bit of background on the company, Wedgemount's an E&P company based in West Central Texas on the eastern shelf of the Permian Basin. Our focus is on the purchase of under-optimized oil and gas assets. We acquire, develop, and operate distressed oil properties. They can either be financially distressed or operationally distressed. Ideally, they're a combination of the two. So we acquire core areas of producing low entry cost assets, and we use really innovative enhanced recovery techniques to get the best out of the wells, the surface facilities, and most importantly, the reservoirs and reserve recovery. And we do that in a very low risk manner by optimizing the existing wells. All of our wells are producing. There is no exploration in what we do in this part of Texas. All the assets are really well known. Getting into a little bit about what we've been up to, but just before I get into that, just a bit of the background here. Why we like the opportunity, why we're doing what we're doing. I think it's really important. We really like the timing of being in the oil and gas industry at this time. I've been around the industry for about 25 years. We really like the fundamentals as far as global demand growth and really the end of hypergrowth in a couple of the core producing basins, and particularly in the Permian Basin of West Texas, where growth has really started to slow down over the past 18 months. As I mentioned, we're on low-risk assets as the focus. Our team, we got an outstanding team who's been through this, everything from operations to capital raising and success in all those different core areas of the business. Our structure, our management team owns a huge percentage of the company, including myself, when I'm over 20% on a fully diluted basis. Texas, I think everybody knows Texas in the oil and gas business. It is the second largest producing basin in the world, and one of the best regulatory frameworks. So we're really happy working in Texas. Getting into the team, I can just touch on this very briefly before I get to what Martin would let off with and what we've been up to. I'm the president and CEO, senior ops manager Heidi Flagg, who's really the core person on the ground for us and brings all the local knowledge, local expertise, and specialty chemical knowledge in Texas. Our CFO, Steve Vanry, 25 years working in public markets, outstanding, and our senior petroleum consultant, Rich Naden, who's a petroleum engineer and really is the one who digs into these assets. Common equity, capital structure is pretty basic there. You can see we're about 52 million shares outstanding, 22 million warrants, fully diluted about 76 million shares. And again, we own about 42%. With a few other large shareholders, we're about 70% is in about 12 individuals. The debentures.
Sorry, Mark, those warrants, what is their exercise price, or where are those kind of priced at?
100% of the warrants are at 30 cents. So the warrants go back from private placements that were done in 2023 when we first purchased the assets. So the warrant expiry on give or take half of them, I think the number's 14 million of the warrants will expire in December of this year and in the first quarter of 2025. The balance of those warrants were just issued as part of our recent debenture financing, and they expire 3 years out in September of 2027. So that's the capital structure of debentures. We got 2.45 million out. Those are 10% coupon with a 3-year term. Oh, the conversion price is at 17 cents. So the warrants were part of the debenture unit, both the debentures and the warrants as part of the last financing. Why West Central Texas? Permian Basin is the largest in the U.S., second largest in the world. There's prolific geology, and there's a ton of opportunities. Because the basin is so big and so robust, major players are focused on the really large assets. Private equity is focused on the large assets. So there's a ton of smaller assets for companies like us that we can go after that slip through the cracks, and we can create a ton of value from. Outstanding partner. Our team includes our head of operations, Heidi Flagg. She's got 30 plus years operations in the area with local expertise, local knowledge, everything from the landowners through the geology, through operations. We have expertise in those areas, and that's what we can really capitalize on these opportunities. The other thing that we do, which is very unique for a small company, is leading edge chemical technology. And the chemical technology not only helps our wells produce better and our surface facilities run more smoothly, but allows us to recover more reserves from all our reservoirs. And another reason why there's so much opportunity here, I talked a bit about the majors earlier, there's a lack of access to good people and equipment, and there's a multitude of financially strapped operators after the downturn in the oil and gas industry from 2014 through 2020. So tons of good opportunity here for a variety of factors. Here's our acquisition development approach, and I'll just touch on this before we get into the most recent deal, because the recent deal falls exactly within our acquisition development approach. This slide should actually say 23-24. But what we do is we acquire distressed properties. We've done 4 deals to date, including the big one that we closed last month. We consolidate adjacent properties. All our assets are in a core area south of Abilene, Texas, a city about 200,000 people. We're about 30 minutes south of town, and we have an office in that town, and a lot of our people come and live in Abilene and come down and work for the day. So it's a really good access, a really good area for people to work and balance home and work life. What we do is we enhance and optimize existing wells. That's one of our existing wells on the right there. A lot of the wells that we bought, or the majority of what we bought, again, have been under optimized, and some of them, for all intents and purposes, have had no work for 10 years plus. So we enhance and optimize the existing wells to get the best possible performance out of those. We return wells to production. Over 50% of our wells, when acquired, were not running for a variety of reasons. Every asset until the most recent one, we put all the wells back on. Part of our program going forward will be to start up and the wells that we just acquired. So we've got a lot of work on that side in front of us. Finally, for the kind of hyper growth, I don't know if hyper growth is the right word, but for continued growth beyond the optimization, we can target behind pipe potential and drill new wells. Post this acquisition, we have over 400 drilling locations. So there's a long way to go here to grow. But that's, if you want to think about Wedgemount and our approach in the most basic manner, this is what we do. This is the slide you should focus on. All right, progress to date. And this will go into Martin's question off the top about what we just bought. We did 3 initial purchases in 2023. We bought a total of 35 barrels a day. We turned that into 300. Again, through our enhancement and optimization with chemicals and workovers. In 2020,
sorry, Mark,
yes.
Just to interrupt. So you bought assets which included 35 producing 35 BOE per day, and
Yes.
through your optimization, that was almost a 10 bagger of production.
That is correct.
You optimized it up to 300. Okay.
That's correct. So that was with the 3 assets we closed in 2023. That's what we did. And again, the real core to this is using best practices on the engineering and operation side, and using the proprietary chemicals, which again help your wells flow better and recover more oil. So in 2024, the acquisition we just closed, that was a 74 barrel a day acquisition. We're around 130 barrels a day, already just a few weeks in on that. That acquisition was an additional 119 wells and 10 injectors. So if it's just on a per well basis or number of wells, we more than quadrupled the size of our asset base with the most recent transaction, Martin. So there's a ton of running room to grow from the 74 BOEs a day. We think we can have the similar types of growth, similar types of returns that we got on the 3 assets we bought last year. So what does that mean?
Within just the last couple of weeks since you closed the acquisitions, that quickly you've been able to go from 74 up to almost doubling it?
Yeah, so there was a ton of low-hanging fruit. The company we bought it from was distressed. And when I say distressed, when we go in there and do our final due diligence, there is so much low-hanging fruit on these wells that we have to deploy very small amounts of capital and time to get them up and running. We still will do chemical treatments and further enhancements, but there was so much low-hanging fruit and work that just should have been done, which was not done. So we just took advantage of that. Obviously, every barrel we add is more cash flow to us. So going back to the organic production growth, and again, this goes back to pre the most recent acquisition, we grew on average of our treated wells over 800%, and we did that at $2,700 enterprise value per flowing barrel. It's a really important metric in our industry. If some viewers are not as familiar with that, that's the enterprise value per barrel of production. So to give you an idea, comps in this part of Texas trade anywhere between 32 to 50,000 EV per flowing barrel, some even higher than that. So the fact that we're actually able to grow oil production at those levels really creates a huge value. Sorry, it creates a lot of value for shareholders compared to where comps and where other M&A is taking place in the Permian Basin. I've talked a little bit about the success, leading edge use of proprietary chemicals. I cannot emphasize this enough. Our head of operations, Heidi Flagg, this is her sweet spot. This is what she does. Before working with us, she worked for a whole bunch of large companies, kind of household name E&P companies. And what she's been able to do is bring her expertise and bespoke solutions to us. And it's really not available to small companies. So it's a key part of our success. Zero exploration risks to grow reserves and production. Again, we're not drilling new wells here. This is our opportunity is fixing problems created by poor historic operations or just a lack of cash. A lot of the purchases we made were off highly distressed or little family operations where they just didn't have the money to do a lot of this basic stuff. For people who are curious about the type of oil we produce, it's 32 to 44 API. So think of this as West Texas, WTI oil. So we get generally WTI pricing. Our netbacks are around $32 a barrel at $75 oil. So think of that's net of production tax, all our operating expenses, sales, marketing, you name it. We're about $32 US a barrel. Now, what can we do beyond this? We've obviously grown a lot, from zero a year or 15 months ago to now 136 wells, 10 injectors, and we're pushing 400 plus barrels a day. There's a multitude of assets in our pipeline. There's 30,000 acres in our core area which we could buy. In addition, there are 720 wells that we've already done due diligence on that we could purchase anytime we want. It's a question of capital, both financial capital and people, and the ability to do these deals. So we will get to those deals. We will continue to grow, and there are a multitude of these opportunities.
Mark, I'm just thinking, like your initial assets from 2023, you moved that up to 300 BOE per day, which is almost 10 times. And then you just bought 74 BOE per day, which you've already almost doubled. With the existing assets and just optimization, could we use the same sort of multiplication on your first set of assets? So potentially you could get up to 1,000 BOE per day just on this asset package, or is that a little too optimistic for?
Actually, we're being quite conservative. I think we can do a lot better than that. So our goal, if people want to think it on a well by well basis, for every well we get, our goal is to get that individual well or an individual well somewhere between 15 to 20 barrels per day. That's what we've been able to do so far. I think we're averaging about 16 on our wells that are fully optimized. So chemical treatments, workovers. So our goal, 12 months out, I'd like to be just over 1,000 barrels a day. I think we've told people sort of 1,100 to 1,300. 1 year from now, 2 years from now, I'd like to be over 2,000 BOEs a day. And that's just with the existing assets. That's without drilling any new wells. If we start drilling new wells, the numbers could get quite big after that or post drilling. But right now, we find the best return on invested capital, Martin, is to enhance and optimize the existing wells. So, 2 years from now, people should come and talk to me and say, hey, I saw this podcast you guys did or this online presentation. I'd like to be somewhere around 2,000 barrels a day, just with the existing assets, assuming no more acquisitions.
To get it up to, let's just say 1,000, what kind of investment would be required in that? Is there any ballpark figures?
Yeah, absolutely. And we tinker with our model all the time, trying to find the best way to get that or the most cost-effective way to get the best returns. On this financing we just did, you can see we raised around $2.5 million Canadian, so just under 2 million US. The acquisition was 840,000, and that balance of just around $1 million US will get us to where we want to be, because as we're deploying more capital into the new assets, they're delivering more cash flow on a monthly basis, because again, we're selling oil every single month. This is not exploration. It's not like we drill wells and we wait and have to tie in, and it can be months and months. It's literally, as we deploy more capital, we get cash flow back. So we feel like we're in a really good shape right now as far as cash on the balance sheet and monthly oil sales to finance this internally. But I think, Martin, the number you want to think about, at least to get to that 1,000 barrels a day, about $1 million of capital from us, plus a bunch of working capital, and then we will have excess at the end of the year. And I'm certainly happy to share more information with people on that. So here's kind of what we've done overall. So producing wells, just so people can look at us post the acquisition, we're now a 136 well company. If you take the first 4 acquisitions, we acquired 108 barrels a day. Again, as I mentioned before, we're around 430, give or take the day of the week, because we're doing so much work in the field. Some days we're shutting in wells to do work. Some days we're bringing on more. But I would be very disappointed if this number didn't grow quite significantly between now and, let's call it, the end of January 2025, as we bring more wells on. Purchase price per flowing barrel, around 22,000 per flowing barrel. The cost for the chemical treatments and workovers per well is about 35 grand. The average increase in production per well, about 13 barrels. Remember, I said we try and get them around 15 to 20. So usually we buy a well, it's doing somewhere between 2 to 5 barrels a day. Organic growth cost per flowing barrel. These are for the chemically treated wells. I just want to be clear about that. So what we call fully optimized, you're about 2,700 a flowing barrel. So your all-in costs, and a number I think it's important for people to focus on. So purchase cost plus optimization costs, you're around 7,750. That's where we are. So if not around, that's where we've been to date. And remember, those Permian comps, which I've got at the bottom there, the last bullet, are 37 to 60,000 per flowing a barrel. That's where the M&A market is, and that's where the listed comps are trading. So the potential for value creation from 7,700 to 37, even if you're at the bottom end of that range, is significant. And that's really why I decided to pursue this opportunity, and why I was able to attract members of the team to do this work, because there's such a potential for value creation at a very low geological and engineering risk.
And just to clarify again, these are all conventional drilling. This isn't fracking or horizontal or any of that crazy stuff, is it?
Of our 136 wells, we have 2 historic horizontal wells. So these would be open hole, conventional horizontal, not frac. So we are not in the shale or hard rock or unconventional type of the basin. So think of us as vertical, conventional sandstone and limestone wells. Our average depth is anywhere between 3,600 to 4,000 feet.
All right.
And if you're thinking about, by the way, on that, I think it's an important point, as far as drilling in this part of Texas, our costs, drilling costs on a vertical well, let's call it in the middle of that range, so around 3,700 feet, you're going to be about 750 grand US all in, drill case complete tie-in. And for a horizontal, obviously it depends, for the cost on a horizontal, it would obviously depend how long your horizontal leg went, but you're probably around $1 million to $1.2 million for a horizontal well. And trust me, we are very excited about the opportunity to drill horizontal wells here for future development. But right now we're getting such good returns from the optimization that that'll be a 2026 part of the plan before we start drilling those wells.
What are how old are these wells? What's their lifespan and the decline rates and so forth? There's still plenty of life left on them?
Yeah, absolutely. And we wouldn't buy any assets that didn't have significant reserves left. Now, it's not quite for viewers in Canada where you can pretty much look at every well and every reservoir and every pool that's ever been developed and get all the data at your fingertips from AccuMap or GeoScout. In the US, it's up to operators to report to the Texas Railroad Commission. So we have a bunch of data. It's not always perfect on these, but that's where local relationships really come into hand here. But our assets, that we're in a variety of different sands and different pools. But if you were to average primary recovery to date on our assets, you're somewhere between 7 to 9%. On primary recovery in these types of assets, you should end up in light oil in this part of Texas, where the industry's been around for 90 years. You should get somewhere between 15 to 18% on primary recovery. Then there's an opportunity for water flood or polymer flood, basically what we call secondary recovery. And because we already have injection wells, we're already doing pilots on that as well. So that's the reserve as far as reserves that are left. The average age of our wells is around 15 years, which is fairly young for an oil well. I mean, there's oil wells still producing in this, well, all over the world that are 60, 70, 80, 90 years old. Our wells are about, on average, approximately 15 years old. So a lot of meat left on the bones here. And if people see the production numbers per well, so they probably heard about, big fracked horizontal wells in different parts of the Permian or Western Canada that come on at maybe 300 or 400 barrels a day. That's exactly right. But those wells can be 7 or 8 or 9 million bucks, and they decline quite steeply over the first few years and maybe flatline eventually at 80 or 90 barrels a day. Some of the biggest M&A transactions that have happened in North America in the past year are for that multi-thousand well packages that do 6 to 8 barrels a day. So the fact that we can get to 15 to 20 just optimizing existing wells is highly economic. So that's kind of where we are. It's been a real busy time for us, obviously closing the deal. So we closed the newest acquisition in September. We raised the capital for it in 2 tranches in August and September. And really the onus is on us now to execute. We have the cash, we have the asset that really will take us from being just a tiny producer to a decent small cap size E&P company. And we're super excited about the prospects.
In about a year from now, you should be like you've given a 2,000 BOE per day kind of target for, I think that was a couple years out,
2
maybe
years, yes, correct. Yeah.
like 1,000 a year from now-ish, something like that. At what point do you get, because right now you're still pretty small potatoes in this whole thing. At what point do you sort of hit a magic number where it's like, oh, this is still a small cap producer, but you kind of hit the radar of things? Is it 500, 1,000, 2,000 barrels where people can start taking you, not that they're taking you not seriously now, but where you hit the radar?
Totally understand. So in Texas and Oklahoma, the old saying apparently goes, because I'm fairly new to being an operator in Texas, is that once you're there 1,000 barrels a day and you can point to getting to 2,000 barrels a day, people will take a meeting with you. They'll talk to you. They'll give you the time of day because it might get interesting. Once you're 2,000 barrels a day, they come and knock on your door.
Okay.
So that's where you need to be. So for me to justify when I talk about some of those comp multiples, I think that's important, Martin, to be there. We're very lucky in our company that we have access to all the private and small M&A activity in Texas, Oklahoma, Colorado, and Wyoming, which is really helpful. So we're pretty on top of kind of the metrics and the multiples being paid for these assets. So I think, like I said, we need to be bigger than we are now. We've done a great job so far, but we really need to get to that 1,000 barrel a day next year, then 2,000. And then again, once we start drilling this asset, the sky's kind of the limit. Not the sky's the limit, but I think we could be 4,500, 5,000 barrels a day. But again, that's a little bit down the road, dependent on oil prices, access to capital, et cetera. All the normal things in the oil and gas industry that we can't control on a day-to-day basis.
All right. And you just did this acquisition. Is this now all consuming for you, or could you contemplate other acquisitions going forward, or do you need a little bit of sort of digestion time before you can reload?
There's a few smaller tuck-in things that I think will just I would say that you'd probably see us do within the next quarter to 2 quarters. As far as a bigger bite size, I really want to see the ramp up of these assets. And I don't just mean the production ramp up, because at the end of the day, all that matters is the cash flow you're generating from operations. And once we get comfortable with that, I think you could see us being a bit more aggressive. The other thing too is, once we get, over that 500 barrels a day towards 1,000, we will look at what optimal capital structure is for a company like us, and taking on a little bit of debt might make sense as well, particularly if you're buying operating cash flow producing assets rather than exploratory assets. So we consider that. But right now we've got a ton on the table. We'll be opportunistic, and I think you'll see us do some smaller tuck-ins. As far as something bigger, I would think you'd be at least 2 quarters out. And we know what we want to acquire on that side as well. The deal's there to be done. It's more timing and cash on our side. The last thing I would say too is we own, myself, own over 20% of the company. I've got a lot of my personal wealth in this deal, and we really run this like a private company, for not as far as the marketing, but I mean, as far as how we pay attention to all the costs on a day-to-day basis in this. We've got a ton of skin in the game. And if we need to be a little patient and to really feel confident about the financial strength of the company, we will be.
All right. Oil prices have had a nice they really got beaten up here a little while ago, and with the global issues going on, we've seen some recovery here. That upside all falls to the bottom line for you guys, right? And I guess it seems like in retrospect, you had very good timing on this acquisition. Probably the lower prices help facilitate the pricing and just the transaction happening as well. And I guess what I'm basically saying is just sort of talk about you and the context of oil pricing and that.
Yeah, well, in our view, I don't see, unless there's some, serious escalation of the already escalated situation in global geopolitics as far as the Middle East is concerned, I can't really see oil going above $90. I don't see a lot of fundamental reasons for oil going well above $90. Again, outside of some, black swan event. I mean, who knows what that could look like in this day and age. I'd never rule anything out, but I think it'd be hard over 90. There's a fair bit of OPEC spare capacity right now. So I think, if you saw prices go up, I mean, OPEC probably would start producing a little bit more. And as far as the downside, you're already seeing it, as you just talked about. We had prices really come down from the sort of $80 level down to, I think we got as low as 65 2 or 3 weeks ago. But even seeing how responsive, particularly the North American industry is with rig counts. So I think if you saw oil down in the $60 range, I don't think it's staying there very long, because I think you'll see a supply response. But I would say I have to look at it over the medium and long term. I just look at global oil demand as 103 million barrels a day. By 2030, you're probably looking at, close to 110 million, 112 million barrels a day. I don't know where that extra oil is going to come from. So we're pretty excited about the fundamentals for oil over the longer term. Even if you had Saudi turn the taps on and the rest of OPEC turn the taps on, you're not seeing a lot of growth anywhere else other than Guyana offshore.
I think we've covered everything. There's nothing that's sort of sticking out in my mind of needs to be addressed. Anything you want to comment on before we wrap things up?
Yeah, I would just say that the reason we decided to build this company focused on these projects is, in my 25 years in oil and gas, this is probably the lowest risk, highest reward scenario I've seen. It's just shocked at the quality of the opportunities that we're able to acquire at such low rates or such low costs down here in Texas. So we're excited. So stay tuned. There's a lot of growth to come, a lot of excitement to come.
Actually, sorry, just something popped into my head. You had a little update on the new assets you issued today in a news release. And what kind of, you said you're going to be giving additional updates, I guess, as production increases. What kind of news flow should investors be watching to get updates on how things are progressing?
Yeah, I would think we're going to have multiple before year end, and those will really be production related as we turn on more wells on the Huggy assets, which is the name of our most recent acquisition. So production updates, and specific there's some very specific leases and wells within the package that we think have more upside, let's call it surprise, for maybe the market than what people think of as us in this part of the state and these types of assets. So you'll see general production updates, field operation updates, and I'm hopeful we'll have some exciting news around specific wells coming up. But really, it's just going to be updates, production, cash flows, and hopefully some juice to go with it.
All right, that's great. Mark, thank you very much. That was really good. Great update. Great story, and all the best. And I look forward to watching the news and getting updates from you. Thank you.
Thanks for the time, Martin. Appreciate it.
Cheers.